Okay, I'm going to be going over chapter 6. Assignments are due for chapter 6 on October 9th. I'm recording this 2 days early because I'll be out of town on Sunday. So hopefully everybody has read their announcements to be reminded that there won't be a live session on Sunday at 7 o'clock. So we're going to talk, like I said, about cash controls and really liquid assets is really what we're going to get into. Then the beginning of the chapter focuses on internal controls, because if you're going to be subject to theft or other bad practices, it's usually going to be these type of assets that are going to be most at risk. And so internal controls, as you can see by the slide, protect your assets. They ensure that our accounting is properly done so that we're not misreporting information, that we're following company policies, and we're promoting efficient operations. If you're getting bad numbers, then you're running a bad operation. And if you're working for a large company, that becomes job threatening. I'm going to skip ahead on some of these things because you can read about these things in your book. Now, there's certain common practices that you need to understand need to be followed. The first thing is every company needs to establish responsibility for internal controls. Adequate records need to be maintained to ensure that the controls are there. You're going to bond key employees. What that means is, besides having insurance on the things you own in case they're stolen or lost due to a disaster or something, you also want to make sure key employees are bonded. So if you have an employee who does something nefarious, like embezzles money, they're insured and you're covered for the loss. Now, what does the insurance company do to protect its interest? Well, they're going to investigate the heck out of that person and make sure that they've done everything reasonable to determine whether or not that person has the potential for creating a claim against them. You're going to separate record keeping. We're going to see that the person that makes the deposit isn't the same person that records the entries into the accounting ledgers. Just an example. It's separation, okay? The person closing down the cash register at the end of the night doesn't check themselves out. A manager does that, okay? In the restaurant business, before computers came along, we used to have a person come in and audit the checks that were given out to customers to make sure that the cashiers were not shorting the check and pocketing some of the money when the customers would go to leave, because it was all done by hand. It was all handwritten back then. You can see applying technological controls and perform regular and independent reviews. And I'll give you an example of that shortly. Well, in fact, I'll give it to you now. I'm going to skip ahead from these further explanations. Again, these are in your book. They're part of Smart Book, so I don't feel a lot of these require explanation. One of our jobs as district managers and district directors was we were to go in when we did a visit and look at the cashier report. Now, this is an example of internal reviews, okay? So we pull out the cashier reports and we see when the money was getting to the bank. I had a manager at the Pine Street store, Pine Street Shoney's at the time, who had borrowed $2,500 to pay gambling debt back in the day of video poker machines. And what he was doing was rolling deposits. So he would hold on to a deposit for 2 deposit periods. A deposit period would be at the end of the day, the afternoon, and then at night. Well, he would roll one of those deposits every 24 hours so that nobody would think the money would be missing, right? But those deposit slips are time stamped, and we can see the date they went to the bank and the time the teller checked them in. And that's how we caught them. We matched up the deposit slips. And was able to determine that he was making $2,500 exactly 24 hours late beyond the time that he was supposed to. So that's just one example of many of internal controls. Now, your book discusses blockchains because this is something that's coming online. And blockchains are what we would say were in the cloud, and they are able to maintain counting ledgers and mainly used for cryptocurrency, but they can be used for regular currency as well, so that you can relatively be assured that changes can't be made and somebody can embezzle. However, I've been around long enough to know that given enough time and given enough of a challenge, even the best locks can be hacked into. And it's a matter of time before something serious happens with this. They say changes cannot be destroyed or hidden for now. We'll wait and see, because again, over time, I have seen just about every way possible that people have been able to steal from a large company. Now, you need to understand these things. The fraud triangle is three things: opportunity, pressure, and rationalization. Opportunity means you're leaving the stock room unlocked. Pressure means you see other people getting away with stealing, and you want to go and you join the crowd, so to speak. All right. Sometimes you'll be pressured by somebody because you're in a particularly vulnerable area, and you could be pressured from inside the company or outside the company. One time, it came to our knowledge through a tip that somebody was stealing food out of the kitchen at night, and they were getting it out by taking it out with the trash and putting it in the dumpster, and then they would come back after everybody went home and pull it out of the dumpster. And we're talking, a case of hamburgers was about 40 hamburgers. All right. And that's what we were losing. Then you have rationalization. Well, the manager was mean to me tonight, and I'm going to get back at him by taking this bottle of tequila home with me. All right. So a lot of the policies you put in place are geared to preventing theft. We had a saying in the restaurant business: locks are made for honest people. If you have a thief, they're going to figure out a way to defeat your system or get close to it. But if you have, controls like locks on storage cabinets, okay, like doing an inventory count of expensive items before you go home at night, okay, there are things you can do in order to have these internal controls. And some of you may have thought some of these things by companies you work for were ridiculous. And why do we have to go through this? Well, you have to go through it to keep you from having the opportunity to steal. It's just that simple. And if I seem, more geared towards the negative side of this, it's because I've had to deal with it for 25 years during my time in the restaurant industry. So that's really an explanation what the fraud triangle is all about. There's a constraint called the cost benefit constraint. So you don't want to have an internal control that's so burdensome that it's going to cost you more to have the control than what the loss that it was designed to prevent. So we're first going to talk about cash control. And the very important thing is that you handle cash separate from the record keeping for cash. And that's what I explained earlier. For instance, when I would come in to a restaurant and I would audit the petty cash for that restaurant, I was doing so. I mean, the manager could have filled out the petty cash slip and sent it in, all right? But there's nobody there to check them. So I would go in once a month and do a petty cash audit, and we would sit down and do it together, so that whatever I sent to the home office for reimbursement was certified, accurate, and correct. All right. It's another policy that's good to follow is that you don't want to encourage cash. You want to encourage checks or electronic funds transfer, because the check or EFT gives you a paper trail, whereas cash doesn't. All right. And one thing for sure that you want to follow is get the cash to the bank, and that includes checks. A lot of people don't balance their checkbook anymore. So if you got a check sitting in your um, desk drawer for 2 weeks before you decide to go to the bank, it could be that money's already been spent out of that account because they're not keeping track. They're looking at their balance every day, and if they got money in there, they're spending it. All right. So these are three really good control measures that you should follow. Now, this is what you need to start making sure you know for the dealing of the transactions and in doing the ratios at the end of each chapter, because now we went into a more detailed balance sheet, and so definitions are important now. So cash and equivalent assets are called liquid assets. Why? Because they're readily available to liquidate. So that's why they're called cash and cash equivalents. But we're looking at coins, currency, deposits, cashier's checks, certified checks, and money orders. All right. What makes these checks that are cashier checks and certified checks important, and money orders, is because they're guaranteed by the people that issue them. So cash equivalents, the definition is readily convertible to a known cash amount and close to the maturity date that it's not sensitive to changes. Would owning stocks be considered a cash equivalent? Yeah, it could be, depending on how long the settlement date is. 5 days is not an unreasonable thing. All right. But if you take a lesser known security, it might take several weeks to clear, may not be considered a cash equivalent. Accounts receivable may or may not be. In most of what we're going to look at, it's not. Now, in managing cash, the thing about managing cash is making sure you have enough cash on hand to keep your business operating. Okay. The example I like to use here is that you buy here, pay here, used car dealers. When they open their lot, they take the money that they're investing in their business, and they'll go put 12 to 20 cars on their lot, and they pay cash for those cars at the auction. Now, when they go to sell them, they do what's called you tote the note, and you go to that dealer and you pay them over time, just like you would a finance company or a credit card, right? The problem with that is they become cash poor very quickly. They have a whole bunch of people that own money, okay, and those are assets, they're accounts receivable, but they run out of cash to go to replace. They might they sell 4 cars, they might maybe have enough cash to go replace that car on their lot. Now, a lot of used car dealers are dealing with this by getting out of toting the note themselves, and they'll partner with a finance company. So when you go in to buy the car, you're actually having a payment arrangement with like a World Finance or Regional Finance or somebody like that, so that and then for a percentage or whatever the sale is, they're paying the finance company that, plus finance company is raking you over the coals and interest. But they're getting enough money to go buy 1 or 2 cars off of the auction lot to replace their inventory on their used car lot. Okay. As far as encouraging collection of receivables, good example I have here is a show called The Profit on CNBC. I think it's a little bit harder to find now, but at one time it was pretty easy to see the episode. And they had one episode where Marcus went in and he was trying to turn around a store. It was a fish store, all right, but they sold fish not just to people walking in. They had a restaurant on the side where you could buy fried fish and take it home, and they sold fish to other restaurants in the area. Well, the fish they were selling to other restaurants in the area, they were selling on credit, and their customers were really slow paying. I mean, they had $200,000 in receivables, and they weren't doing but maybe $700,000 or $800,000 a year in sales. That's a lot of money not to have in your bank account. And so he put the office manager on the phone for a week and gave them the week to, you know, start bringing in some of these collections that were behind. And she was able to cut that in half in just 1 week. So that's why you encourage the collection of receivables. That's why you have the 2 or 3 or whatever discount it is on the terms of like 210 net 30 or 410 net 30 or whatever the case may be, because encouraging a discount to pay early keeps your accounts receivables lower. You can also delay payments to liabilities. If you don't have enough money to pay all of your suppliers, you might have to sit down with a list of suppliers and figure out who gets paid, who's been the shortest amount of time, and maybe they'll get put aside so you can get rid of some of the older debt so that they'll keep selling to you. And what can those places do where you're running long on liabilities? They can cut you off. They can say, you know, they can stop doing business with you. We talked about cutting off 2 of our clients in my business because they were slow payers. Keep only necessary assets. What that means is keep your money in the bank. Don't put it on the shelf. Yes, in retail, you have to keep a full shelf. All right. That's kind of a standard in the retail industry, whether you're a supermarket or you're a record store, it makes no difference. Keep the shelves full. All right. So it always looks like you have enough product. But you don't want to keep more than was necessary. You don't want to stockpile stuff in the back room because you think you're going to sell it. All right. You'll stockpile because you know you're going to sell it. Maybe something's going on sale. But if not, figure out how much you normally go through a week, and that's what goes on the shelf in the front of the store. The other one is planned expenditures. You know, maybe you want to get something remodeled, but make sure you have the cash in the bank before you do it. Okay. And then the last one is really important. If you have a lot of money, for instance, let's say, figure out how much money you need to operate. Keep that in your checking account. But if you have a lot there, move some of it over to the money market. So at least you're getting something for the money sitting there until you need it. You might even want to buy like dividend stocks or something. In this scenario, this really is probably starting to go by the wayside because this is based on old system of doing things. But some of the things may be still done to a certain, it's just the format's different because now it's being done on computer. So you have it in the first diagram, you have a clerk bringing up sales on the register, and when they close out at the end of the day, they fill out a cash sheet. So they're going to list all their bills, they're going to list all their coins, and then they're going to go to the cashier department and they're going to get checked out. Essentially, that's what happens. Well, the cashier department is then going to send the cash to someone who's going to prepare the deposit slip and take it to the bank. But they're going to fill out another slip, and that's going to go to the cashier department supervisor, who's then going to record that information into the ledger, the general journal and the ledger. All right. So your record keeping is separate from your deposit. And then when they come back from the bank, that deposit slip's going to go to the manager, and they're going to make sure all the money was deposited that was reported on the cash sheets that were turned in by the cashier. So when we have cashiers, we have shortages. And I'll be honest with you that when in the restaurant business, if we had a cashier that came up even every night, we got suspicious. All right. Because human nature is to make mistakes. And that used to tell us that they were actually counting every transaction in their head to make sure they didn't come up short, instead of just focusing on their job, which was to make change based on the amount of sales slip and money given to them. So what happens if you come up, in this case, we're looking at overage, all right? So if in fact the cashier turns in $555, okay, but their sales slip says they only sold $550, they're over $5. So when we do the journal entry, we're going to debit cash $555, which is the amount of money that was turned in. Then we're going to credit cash over short $5, and then we're going to credit sales $550. We're always going to credit sales for what was actually shown, not the amount of money that was turned in. Now, what do we do with a shortage? Well, we're going to do the opposite. We're going to record what the cash actually was. In this case, cashier record shows $625, or the cash register shows $625. There used to be a name for this, and I can't remember it for the life of me. And then they actually turned in $621, so they were $4 short. So we're going to debit cash over short $4. Now, something to keep in mind. What does that tell you? Cash over short is like an expense. So if you're short, it's going to be treated like an expense. If you're over, being that we're going to credit that amount, it's treated like sales. But the thing is, our cash over short is going to go in with our expenses when we actually do the income statement. And so that's how it's going to be accounted for. Okay. So you can see here, we debited the cash of $621. We debited cash over short $4, and we credited sales $625. When you are taking care of cash receipts by mail, you have two people assigned to open the mail. Then you have a cashier deposit the money in the bank, and then you have another person who's a record keeper records the amount in a ledger, and it's usually just like a list of dates and amounts. And I'll give you an example. We did an audit at our church, and we had a secretary who would get the money bag that was taken to the bank with all the dates collection that Sunday. And then she would go back to the bank next morning, because we didn't have a safe, so that was our safe, taking it to the bank. She would come pick up the bag, take it back to the office, make out the deposit, and then go back to the bank and make a formal deposit. Now, what was wrong with that? Well, one person did all the transactions. Okay, so there's perfect opportunity to steal the cash that was being left in the collection plates. Well, when we did our audit, we brought this to the attention of the finance committee, and we put in a new procedure. So every day after church, two people from the finance committee would take the collection plates back to a back office. They would go through open all the envelopes. They would list what each person tithed for that day in a ledger book that was waiting for us that the secretary prepared. It had all the members' names and then blank lines for write-ins. And then the two people together would put together the deposit. Then one person would go to the bank to drop the bag in the bank, and the other person would follow. And we had a record in that church office of everything that needs to be on that deposit slip the next morning. Then the secretary would show up, pick up the bag, and then she would take it back and fill out her deposit slip. So in fact, she really filled out the deposit slip based on what we recorded in the ledger, and just had the cashier count it there at the bank. So in other words, we had multiple people involved, actually 3 people involved in this process, to limit the risk of something nefarious happening. All right. I'll tell you another cash control method is when I worked for the IRS, checks, and I got the tour service center in Atlanta a couple of times. And when a tax return comes in, it goes through what they call the sort, and the checks are separated from the tax return. And when they're separated from the tax return, they're assigned what's called a BCN number, and it's stamped on the tax return and it's stamped on the check. So if that check ever had to be traced, we would be able to identify where it came from after it went and got cashed. And then we would have well, there's like 5 or 6 people batching checks that they would put them through a machine like you saw at Walmart, that you put the check in and it would scan the information. Okay. And then it would automatically be taken out of your account. But there was one other step in there to make sure that nothing got lost. All right. And the other extra step that was in there was there was these huge tables that were, I guess they were probably 6 feet by 16 feet with fluorescent lights under a piece of plexiglass. And they would run every envelope over that to see if there was money left in them or checks left in them that were unaccounted for. Not one envelope got out of that service center without going through that scan. These are all different types of controls that, you know, and I was telling somebody today when I was showing how to fill out their deposit for their estimated payment. I said, make sure you put United States Treasury on the check, because every year several employees from these service centers go to jail because they're caught stealing checks that are made out to IRS. And what they do is after IRS, they will then put their name, and then they'll take it to their bank, and not being the most intelligent folks in the world, they end up getting caught because they are able to track it back to their account when the taxpayer complains about their payment not being assigned to them. So, true story. Actually, there's about 250 IRS employees that go to jail every year for doing things they're not supposed to do. Most of it is looking at other people's tax returns, which you're not allowed to do. All right. So there's something called the voucher system. And the voucher system, this is a pretty complex system, but it's the kind of system Michelin uses, BMW uses, the biggest companies all use it to make sure there are controls that are in place so that fraud can't be committed. It starts with, you have somebody that needs something in management in their particular department. So let's say you're in the department that installs tires on cars coming off the line, and you're running low on tires. So you'll have to fill out a purchase requisition. A copy of that will go to purchasing, and a copy will go to accounting. Accounting will hold on to that until the invoice comes in, which we'll get to later. Purchasing will call say Michelin and say, we need tires. Here's how many we're ordering. Here's your purchase order number, so that can go on the invoice and they can match it up with the requisition when it comes in. All right. Now, purchasing is going to send a copy of the purchase order to the supplier, which is Michelin. Then they're going to send a copy of it back to the department that ordered it. Then they're going to send it to the receiving department, which is the loading dock, so that they can be expecting it. And then it's going to accounting, where it's going to get matched up with the requisition. Next, the supplier is going to ship an invoice to accounting. All right. And at the same time, the tires are going to be delivered to the loading dock. Now, the loading dock is going to fill out a receiving report, and they're going to send that to the accounting department to get matched with all the other documents. Then they're going to send a copy to the department that placed the order, letting them know that the tires were here. And then they're going to send a copy to the purchasing department, so the purchasing department knows that the order is complete. But the process isn't complete, because next, the accounting department, seeing that everything is in order by that process I just gave you, is then going to send the invoice to the cashier department, and they're going to pay the supplier. Now, nowadays it's all done by that bank transaction, but wasn't too long ago they cut a check and mail a check to the business. But now it's all done by electronic funds transfer. And then that's the final step. They've been paid, and you go back, the process starts all over again. Now, every restaurant we had petty cash, and they had petty cash for different reasons. When I was with Hungry Fisherman, we had a bar in every store, so we had to pay cash for liquor. Their petty cash was pretty steep. We would probably run, I don't know, $400 or $500 in cash, mainly to buy change to get us through the weekend. And then we had to keep in our checking account enough that we could pay for beer and liquor, because You couldn't charge beer or liquor. It had to be paid full cash. And in most states, that's state law. But there's other things that you need that you're not going to go through that purchase order. So let's say you keep an electrician on call and, you have, I don't know, electronic outlets that go out and you need to get them repaired. So you'll pay them out of petty cash. Low cost supplies, like run out of ketchup on a Saturday night, we would send a busboy or a cook to the store to buy 20 bottles of ketchup. Okay. Shipping fees, an example of that was Hungry Fisherman. We would ship between stores shrimp and fish, mostly shrimp because it kept frozen better. So like if we were out of shrimp, I'd call a store in Rock Hill, on Lake Wiley, and they would, send us like 50 pounds of shrimp on a Greyhound. The next morning we'd be there to pick it up, and we would pay it. They would send it COD, so we would pay for the shipping since we were the ones that ordered it. And if you remember the last few chapters, that's going to get coded to inventory, okay? Because we were buying essentially from someone just like a supplier, and it gets added to the cost of goods sold. All right. So that's the whole purpose of petty cash. Now, at Shoney's, we really only had enough cash on hand to buy change because we really we didn't have to buy liquor in the store, so our petty cash at Shoney's was a lot lower. And by the way, our cash register amount, we would have about $150 we'd set up the drawers with every day. That was included with the petty cash account. So in first example, we have to establish a petty cash fund. Petty cash fund is set up by debiting petty cash and crediting cash. Why are we debiting petty cash? That's a new account. It's the same as cash, okay? And it'll probably go right below cash on your balance sheet. But, it's going to have a normal balance of a debit just like cash does. Now, Exhibit 6.3, make sure you bookmark that. All right. So we have, this is what a petty cash report would look like. Ours had lines for counting the cash. We'd have to list how much money was in each registered drawer, and then we'd have to list how much cash was in the petty cash box. And then we have to list the checking account balance. And then we would have listings for all the different accounts that we would have to spend on. So as you can see here, merchandise inventory for the freight coming in, office supply expense, delivery expense, miscellaneous expense for the different things. Actually, a miscellaneous expense for tile cleaning, that would probably go under repairs and maintenance to be more accurate. I don't know why they couldn't figure that out, but anyway, so these are all the receipts that are in the petty cash box when the petty cash is being reconciled. And that's what it's called, petty cash reconciliation. Now, all of your receipts plus your cash should equal $75 because that's how much we set up petty cash for. So we should have $3.70 left in the till. If we don't, all right, then we're going to be over or short, depending on how it falls to $75, okay? And as you can see here, when you do the general ledger, this is usually done at the home office. So when they do the general journal entry, I've said ledger, I'm going to say journal, you're going to debit merchandise inventory, you're going to debit office supply expense, debit delivery, debit miscellaneous, and then credit cash, because that's how much you're going to write the check for going back to the store so they can replenish their petty cash and bring it back up to $75. If we're going to increase petty cash, we're going to debit that amount and then credit cash. This is what you would do to increase it from 75 to 100. And if you decide to lower petty cash, you're going to debit cash and credit petty cash. Pretty straightforward. Should be second nature by now after all the chapters we've done this with. If you're over short, that's going to get listed on the reconciliation statement. So in this case, it looks like we're short $7. So we're going to add that like we would an expense, so that when they write the check, it's going to bring petty cash up to what the fund balance should be. And as you can see, that shortage is going to go get listed as an expense. Okay. All right, next we're going to talk about bank services. And these are all the different things that go into setting up a bank account for a business. You have signature cards so that they can validate signatures. You have deposit tickets, and they look a lot different than the ones you use for your personal stuff. You can list on some of them up to 40 checks. Bank statements, you're going to have electronic funds transfers, and you're going to have checks. Some banks will give you a bank statement at the end of the month showing what checks were cashed. Some of them will just have them listed. It just depends on the bank and their policy. This is an oversimplified deposit ticket. Some of them, the ones we use, are about 3 times as long as this. But as you can see, you're going to list your currency, then you're going to list your coin, total those up, and then you're going to have your checks listed on the back, and you'll bring that total forward and come up with your net deposit. All right. This is what a check looks like, and some of you probably have never seen one before. All right. But there's 2 parts to it. The upper part is the check itself. All the things you see on it are necessary for this to be negotiable. You're going to have listed at the top who owns the account. You're going to have a payee, and that's the person that you're addressing the check to. You're going to write it in by hand, the numbers, and then you're going to do the written form of the number, finishing with the cents over 100. Okay, that should really be 00 over 100. And then you have a memo section where you can put what it is for, so you can refer back to it later. You're going to have a routing number at the bottom, and then the account number. And then some banks will have a third set of numbers where it's going to be the check number of the check that you're writing. If you look down below, there's a remittance advice, and that's so that the person getting the check can tear it off and match it up with their paperwork to help them keep track of who's paying what. And again, a lot of this, the only thing that's normal is about how the check's written at the top on the personal level. The remittance advice normally is not done on checks written to individuals, just businesses. All right, next we have what's called a bank statement. And I'm guessing if you're like my face-to-face class, many of you have never seen one of these, because you've never taken the time to download it. But this is what a bank statement looks like, and it shows all of your activity, both withdrawals and deposits, over the period of 30 days. At the top, you're going to have a balance that shows up for the last day of the month, and that's going to be your beginning balance next month. So you're going to have to do what's called a bank reconciliation. And what's important about a bank reconciliation is you got to match what the bank has against what you have. And you all should be doing this every month for your personal accounts. And I'm betting, well, maybe there's 1 or 2 of you out there that has, but track record's not been good in my face-to-face classes for the last 5 or 6 years. So what you're going to do when the bank statement comes in is you're going to have 2 columns. You're going to have your bank adjustments and your book adjustments. What's a book? Well, your book is your cash ledger. All right. So you're going to be balancing what the bank says against what your books say to make sure you equal each other. Now, the thing about the bank balance, what are you adjusting for? Well, you're adjusting for what the bank doesn't know. The only thing the bank knows is what's on that statement that you just got in the mail. They don't know about deposits you made between the time they mailed the bank statement and you received it. Okay. They don't know what checks haven't been cashed yet. And they don't know what bank errors have to be corrected. So those are the three things you're going to be making adjustments for on the bank side. And after you make those adjustments, you're then going to go over to the book side, to the cash ledger, and you're going to make adjustments there. So you're going to add the interest earned, and you're going to add the unrecorded cash receipts. Okay. You're going to subtract the bank fees and the non-sufficient fund checks. These are going to be on the bank statement, by the way, but you don't know these things until you get the bank statement. All right. And then finally, you're going to have to add or direct correction of book errors. In this slide, I mean, yeah, you can see that this is the process you go through. You take the cash bank balance per bank, which is in the example we saw October 31st. I think it was $2,050, if I remember right. You're going to add the deposits that are in transit. What deposits are those? Well, if you go to the bank at October 31st at 9 o'clock at night, there's nobody there to take your deposit. You're going to put the bag into the drop slot and come back the next day when they actually work the deposit. That's a deposit in transit. That's going to go on your November account. So you got to add those deposits in. How do you know what they are? Well, you've got them sitting there in your cash ledger. Then you have to adjust for outstanding checks. Again, you're going to match the checks that are on the bank statement against your cash ledger, and the ones that are missing are outstanding. So they get added into the bank side. And then you're going to adjust for bank errors, and we'll look at a couple of those. So that gives you the adjusted cash balance. That has to equal the book adjusted cash balance. So let's see if it equals it. Next, we're going to record the cash balance at the end of October 31st. All right. So we'll go back and look at what the balance was then. Then we're going to add whatever the bank, maybe we had the bank collect some accounts receivable for us. They paid us some interest, that gets added in. Then we're going to deduct bank fees because, we don't know what the bank fees are, and we don't know if any checks bounce until we get the bank statement. So those things are going to get minused out. And then we're going to either add or subtract book errors. And there's a slide here with an example on it. In this particular example, we see that the bank statement said 2050, that there was a deposit that was not listed on the bank statement that we made for $145. So we subtotal that to $21.95. Then we had two outstanding checks that weren't on the bank statement. So then we deduct those. So we're going to deduct the total of those came to $350. That gives us an adjusted bank balance of $18.45. Then we're going to go pull out cash ledger. We're going to put the balance of $14.05 in there. We're going to add in the note that they collected. The bank collected a note but didn't tell us because they tell us when they send the bank statement. We also earned $8 in interest, so we have to add that in. And that gives us $18.98. But then we had some checks printed, and we had a check that bounced from one of our customers for $30. So we're going to total those up, and we're going to minus out $53, and that gives us $1,845. Both sides balance, so we have reconciled successfully the bank statement. Okay. You might want to tag this exhibit here, 6.7. Now, you're not going to get tested on this, but this is a point of trivia. All right. When you get hit with a check that bounced from a customer, this is like businesses don't like to accept checks. You're not only going to have to deduct the amount of the check they wrote, but the bank's going to charge you through the nose, sometimes as much as $50 for a check that bounced. Okay. So actually, if that was my bank and a $30 check bounced, we would be getting hit with two charges. One for the bounce check of $30 and another for the fee for processing that, because yeah, we got to pay it of $50. Now we're going to collect that from the client when they come in. But anyway, in this particular one, let's see. I'm trying to think what here was missing. Nothing. I'm not sure why we have these separated steps. Oh, I know why. In the first one, we were looking at doing the bank side, and then this one, this screen right here is the book side. But both of them were listed up there, so it makes no difference. Now, after we do that, we have to make some journal entries. So for what we did not know, that we found out when we got the statement, all right, we have to do general journal entries after we do the bank reconciliation. So the first one is the note they collected, $485. And here I'm going to take you back. You can see right here, collected note, $485. All right, we're going to debit cash and we're going to credit notes receivable. On the next one, interest earned, we're going to debit cash and we're going to credit interest revenue. And what I'm referring to is right here, interest earned, $8. Now, on these two charges we're deducting, all right, we're going to have to, in each case, we're going to credit cash, all right, because our bank balance was lowered by these two expenses. First one was miscellaneous expense, which is a check printing charge. Now, I wouldn't put it there. I put it in office expense, but that's just me. And then next we have the bounce check. So what do? Well, until we collect the money from Mr. or Mrs. Woods, we create an accounts receivable account for them. So that bounce check of $30 is going to be a debit to this new accounts receivable account, and we're going to credit cash since it lowered our cash balance. Okay. All right. Now we're going to compute some ratios. First one is days sales uncollected. This is a measure of accounts receivable. All right. And the higher the number, the worse it looks. All right. We want to be collecting the money as rapidly as possible. We already talked about that. That's a good control practice. Is make our credit customers pay quickly. So we're going to take the accounts receivable, divide it by our net sales, and multiply it times 365. If you look at the two companies compared, Starbucks and Jack in the Box, and it's funny, I 2 years ago, I made the comment, I can't believe Starbucks sells on credit. And lo and behold, I had a Starbucks employee in the class who set me straight. They do have accounts receivable accounts. A lot of them are companies that will order in large quantities and, put it on my account, that kind of thing. So if we look at Starbucks, 2 years ago, they were 14.2 days. And then within a year, they got it down to 10.2. But then in the current year, it went back to 12.1. I don't know what they did a year ago, but they did something right. And apparently they got slack in the current year. Look at Jack in the Box. They went from 20 days down to 17.3. So again, they might have been doing something right to get their accounts receivable lower. Again, I can't imagine going to Jack in the Box and saying, put it on my account. So anyway, that's the end of the chapter. Okay. Where you're going to run into the most difficulty is reconciling your bank accounts, because you've never done that before. So go back and review the information that I talked about in the slide. The best way to look at this, I'm going to go back up to bank reconciliation. Here, we're reconciling for what the bank does not know. So these are coming from our books right here. On this side, on the book side, we're reconciling for what we didn't know. There's no way we can know what our interest was. All right, because it doesn't get calculated to the day the statement goes out. There's no way we could know that a check had bounced unless a lot of banks will send you the check with a letter attached saying, "Oh, you got a bounce check. Here's what's coming out of your account." But you should get my drift. This is what the bank doesn't know that we have to adjust for. This is what we don't know until we get the bank statement and what we have to adjust for, and both sides will equal each other. Okay. As always, feel free to email me if you have any questions. I will be out of touch Monday because I'll be traveling, but you should have a pretty easy time of getting me at any other time. By the time you view this, you're going to be down to 6 days on the accounting cycle problem. So I want to try, if I can, to try to do a video on it, but it won't get posted until I get back in town. So you're just going to have to, go attack it, do the best you can on it. If you're confused on any of the entries or what to do, just get a hold of me and I'll try to help you out as best I can. Okay. Have a good week, and I will be seeing you all live on the 9th.